The government needs you to own its bonds. It also wants you to invest in stocks and real estate. If you wish to invest in fine art or in collectibles, the government doesn't mind it at all. It is even willing to allow you to hold Bitcoin and other cryptocurrencies. There's only one asset which the government doesn't want you to own, and that is precious metals. It will never admit so publicly, but there is evidence to suggest that the US government is actively discouraging its citizens from holding gold and silver. Why is it doing that? What is so special about these metals that holding them makes you an enemy of the state? If you've ever held a bar of gold or silver in your hand, you must know the feeling. Their beautiful appearance and hefty weight give you the immediate sensation that they are valuable. This is undoubtedly true. Gold and silver have unique physical properties, which make them an essential resource for industry. They are also extremely rare and increasingly difficult to locate and mine. They have a monetary history which spans thousands of years, and a proven ability to withstand inflation and economic crises. So why are they so unanimously hated throughout the financial industry? Why are the few who invest in them constantly mocked as doomers and conspiracy nuts? In my view, this is not a coincidence. At the end of World War II, the United States became the leading superpower. While the rest of the world lay in ruins, its territory was largely unharmed. Its economic and military might was unparalleled. It also had over 20,000 tons of gold in its vaults, which at the time represented 70% of the world's gold reserves. Therefore, it was agreed upon during the Bretton Woods Conference that the US would back its currency with gold at a fixed rate of $35 an ounce, and that the other nations would back their currency with US dollars. As you may recall, American citizens were not allowed to own any gold bullion at the time due to Executive Order 6102. Which was issued by President Roosevelt in 1933. Foreign governments and central banks, however, were allowed to redeem their dollar reserves in exchange for gold, if they so chose. During the 1960s, the United States formed the London Gold Pool, a group of 8 central banks which collaborated in order to maintain the price of gold at a constant rate of $35 an ounce, as stated in the Bretton Woods Agreement. This was achieved by selling some of their joint reserves into the market whenever the price rose above $35 an ounce, and buying it back whenever the price fell back down. This method was successful at first, but as the federal government increased its spending on social programs and on the Vietnam War, and as the supply of dollars in circulation increased, it became more and more difficult to maintain this price. The US lost half of its reserves in an attempt to keep the price at bay, but eventually in 1968 the gold pool collapsed, and the market price of gold rose as high as $43 an ounce. Governments, who were still allowed to exchange their devalued dollars at the old rate of $35 an ounce, took advantage of the situation, and the amount of gold held at Fort Knox continued to fall. In August of 1971, President Richard Nixon suspended the convertibility of dollars into gold, in what is now known as the Nixon shock. Fearful that the US may lose the rest of its reserves, he reneged on the Bretton Woods Agreement, and severed the last connection between the dollar and gold. As a result, the US dollar became a pure fiat currency, which is backed by nothing more than trust. At the same time, gold and silver became the adversaries of the dollar. Their price serves as a constant reminder of how much purchasing power the dollar has lost. Shortly after, the price of gold started rising relentlessly. By the summer of 1972, it had risen to $70 an ounce, twice as high as it had been during the days of the London pool. After a short correction, it continued to climb, rising by mid-1973 as high as $120 an ounce. At that point, the American public began clamoring for private ownership of gold to be legalized again. A notable advocate for this cause was Jim Blanchard, who founded the National Committee to Legalize Gold, and later went on to establish a successful bullion investment firm. It is said that President Gerald Ford has seen one of his TV commercials in which he held up a bar of gold and asked, "Why can't I own this?" This has persuaded him to undo Executive Order 6102, effective from 1975. Concerned that the legalization of gold ownership would lead to another surge in the price of gold, government officials started looking for ways to keep the price in check. Thanks to WikiLeaks, we have a telegram which was sent to the State Department in December of 1974, describing a meeting between American diplomats and the leading gold dealers in London. During this meeting, the dealers expressed their view that the formation of a gold futures market will attract the majority of investors, and that the demand for physical gold will be minuscule by comparison. They argue that this will create a highly volatile market, and that the large price swings will deter investors from holding gold for the long term. Such a market was indeed established shortly after, as futures contracts on gold started trading in New York on January 1st, 1975. It is quite clear that by establishing a futures market for gold, the US government had hoped to control its price, and for a while it seemed to work. Immediately after the futures market started operating, the price of gold entered a deep correction. By August of 1976, the price of gold retreated by almost 50%, from $195 all the way down to $100 an ounce. But the rate of inflation, which was already running hot for several years, started surging again. From a low of 5% per year, by 1980 it gradually increased to 14%. The price of gold went absolutely ballistic, rising as much as 8-fold during the same time period. The price of silver did even better. Although it started moving only in late 1977, it ended up rising 10-fold. These spectacular gains caught the attention of investors all over the world. They've also kept Federal Reserve governors awake at night. There was a real concern that the US dollar may lose its global reserve status. In order to stop the bleeding, Fed Chair Paul Volcker was forced to raise rates as high as 20%, which led to a painful recession. This gave the dollar another lease on life, and pushed the precious metals into a bear market that would last for 20 years. During that period, policymakers must have forgotten all about gold. The public grew accustomed to fiat currencies, and their trust in the system seemed unwavering. It was only after the bursting of the dot-com bubble in technology stocks that commodity prices started to rally, and precious metals became relevant again. Between 2000 and 2011, gold and silver had another meteoric run, which was only briefly interrupted by the crash of 2008. Similarly to what happened during the late 70s, gold went up almost eightfold, and silver again went up tenfold. In order to bail out the financial system, the Federal Reserve slashed interest rates to zero and embarked on its first quantitative easing program. Investors were rightfully concerned that this would lead to inflation and perhaps even to the collapse of the dollar. Therefore, the US government had a strong incentive to suppress the price of precious metals. We believe that it was at this point that the war on gold and silver went into high gear. Ever since, the federal government has been doing its best to prevent the public from owning precious metals. It has used the financial media in order to discredit anyone who invests in them and portray them as lunatics and conspiracy theorists. It has weaponized the academia in order to promote the use of fiat currencies and shame anyone who calls for a return to the gold standard. But its most effective tool is the constant price manipulation which is taking place at the commodity exchange. Unfortunately, people tend to chase whatever asset whose price is currently rising, regardless of its true value. By suppressing their price, the federal government has been able to divert people's attention away from gold and silver. Assuming that you have enough dollars at your disposal, it is not difficult to manipulate the price. All you have to do is to open a large short position. This creates the appearance of an abundance of supply and pushes the price down. Whenever the price rises and approaches a technical breakout, you increase your position. And whenever the price drops, you can unwind it a bit and pocket the difference. Since most contracts at the commodity exchange are settled in cash, and since very few people stand for physical delivery, this charade is allowed to continue. This is presumably what the large banks in the US have been doing for decades. Officially, this type of activity is illegal. But since the regulator in charge of the COMEX, called the CFTC, has been looking the other way, we may assume that the banks are acting at the behest of the federal government. Whenever asked about this short position, the banks claim that they are merely acting on behalf of their clients, such as mining companies and bullion dealers, who have large inventories of precious metals and have a legitimate need to insure themselves against a sudden drop in their price. But legitimate hedging needs do not account for the sheer size of this position. According to the Commitment of Traders reports, the 8 largest traders are currently short over 140 days of global production of silver, over 100 days of global production of platinum, and over 70 days of global production of gold. As you can see from the chart, no other commodity has such a huge short position. There are other signs that something nefarious is going on at the COMEX. Take for instance the peculiar habit of the price of gold and silver to drop sharply at precisely 10 o'clock in the morning, New York time, when trading at the COMEX begins. Rational traders, which are seeking to achieve the best possible price for the metals they are selling, would surely avoid this time of day. But for some obscure reason, sellers keep piling in at the exact same time, almost on a daily basis. In my view, there is no other explanation for that other than price manipulation. Similarly, we have seen instances in which a large amount of futures contracts has been dumped on the market during the night, when trading is thin and there is not enough demand to absorb this supply. A notable example of this happened on August 9th, 2021, when someone decided to sell $4 billion worth of gold futures contracts at the dead of night during a national holiday in Japan. This resulted in a sudden price swing of $80 per ounce. Again, no reasonable trader would do such a thing unless they wanted to negatively affect the price. Since this activity is illegal, and since the CFTC hasn't opened an investigation into the matter, we can only assume that the US government is complicit. Another piece of evidence is the following chart, which compares the price action in silver during COMEX trading hours with the rest of the day. We can see that whenever the COMEX is open, the price tends to fall, and whenever the COMEX is closed, the price recovers. This discrepancy is so extreme that if silver was traded only at the COMEX, its price would currently be 20 cents per ounce. And if it was only traded outside of the COMEX, its price would be no less than $200 an ounce. This type of price action is unnatural, and in our opinion, it can only be the result of continuous manipulation. Last but not least, we have the case of Michael Noak and Greg Smith, two senior precious metals traders at JP Morgan, who in August 2023 were found guilty of fraud and price manipulation. The two were convicted of what is known as spoofing, the manufacture of false trading orders, intended to misrepresent supply or demand. This scheme went on for 8 years, involved tens of thousands of false orders, and resulted in over $10 million in losses to market participants. In my view, this case is merely the tip of the iceberg, and the punishment which the two have received amounts to nothing more than a slap on the wrist. I would not be surprised if the two were sacrificed by the institution they worked for, in order to conceal a much larger manipulation scheme. The way in which the price is repeatedly hammered has a demoralizing effect. Average traders, who are only trying to make a quick buck, are getting stopped out and finally get the message and shy away from precious metals. The only people who continue to invest in gold and silver are the die-hard stackers, who recognize their strong fundamentals and historic value. Seemingly, the manipulation can go on forever. The large banks can theoretically generate an unlimited amount of futures contracts, and no one has enough money to call their bluff. But every manipulation is destined to fail. The artificially low price is discouraging production and encouraging consumption. As a result, physical metal is becoming scarce, and the COMEX has fewer and fewer ounces in its warehouse to satisfy those who actually stand for delivery. Once it runs out of metal, the manipulation will end. Officially, the exchange will not go bankrupt. It has the legal authority to force all contract holders to settle in cash. But once the news spreads that the COMEX is unable to deliver physical gold or silver, it will lose its legitimacy and no longer be able to dictate the price. This is what we call the silver squeeze. It is our firm belief that by purchasing physical gold and silver, we can deprive the exchange of these precious ounces and eventually lead to its downfall. Once we expose the COMEX as nothing more than a tool for price manipulation and suppression, we will have true price discovery for gold and silver. Their true value will finally be revealed, and we will once again be able to use them as money, just as we've done for thousands of years. Thank you for listening to the Silver Hermit podcast. If you like this content, please donate in the link which appears in the description below. Please subscribe to this channel and share it with your friends and family. Hit the bell icon to be notified whenever I release a new video. Remember, I'm not a licensed financial advisor. This video is intended for general informational purposes only and should not be regarded as investment advice. Before taking any investment decision, please consult with a professional financial advisor who may assess your personal investment objectives and needs.